January 1st, 2026. While most of the world celebrated New Year's Eve, something else went into effect that should have sent shockwaves through every trading floor on the planet. China, the nation controlling 60 to 70% of global silver supply, implemented export restrictions that fundamentally changed the rules of the game forever. Not tariffs, not quotas, complete licensing control over a metal that makes modern civilization possible. But here's what nobody's telling you. This wasn't a surprise move. This was the culmination of a strategy that's been building for over a year. And while financial media focuses on silver hitting $78 per ounce, they're missing the real story. We're not watching a trade war. We're watching the weaponization of the industrial nervous system of the 21st century. Let me show you exactly what China just did. Why Elon Musk called it not good when silver is needed in many industrial processes, and why this represents a permanent shift that makes everything we knew about commodity markets obsolete. This is not financial advice. This is an educational breakdown of market structure. The new rules are deceptively simple. Starting January 1st, 2026, only companies producing at least 80 tons of silver annually can obtain export licenses from China's Ministry of Commerce. That might sound bureaucratic, but let me put that threshold in perspective. 80 tons equals approximately 2.57 million ounces. There are maybe a dozen companies worldwide that meet this criterion. This licensing system effectively eliminates small and medium-sized exporters from international markets. The companies that historically moved silver from Chinese mines and refineries to London vaults, COMEX warehouses, and industrial users across Europe and North America, gone, locked out, no longer eligible to participate in global silver trade. But here's what changes everything. China doesn't just mine silver, they control the entire refining infrastructure. According to industry data, China processes approximately 60 to 70% of global silver supply. Not just what they mine domestically, but doré bars and concentrates imported from Mexico, Peru, Canada, and Australia. These materials get shipped to Chinese refineries, processed into 1,000-ounce bars, and then exported to global markets. Or at least, they used to be exported. Now that flow is subject to Ministry of Commerce approval. Every ounce that leaves Chinese soil requires government permission. This is control over the marginal supply of refined silver at a level never seen before in modern commodity markets. Now here's the part nobody prices in. The timing of this policy reveals the strategic calculation behind it. In October 2025, China recorded record silver exports of over 660 tons. That's massive. But it wasn't business as usual. Chinese exporters were front-loading shipments ahead of expected U.S. tariffs under the current administration. The result? Western vaults received temporary relief. London warehouses that had been drained to near-empty levels got restocked. COMEX registered silver, which had fallen to critically low levels, saw modest recovery. Everyone breathed easier. The acute shortage that had been building through 2024 and early 2025 seemed to stabilize. But that front-loading was China emptying its export pipeline before slamming the door shut. Those October 2025 shipments weren't sustainable supply. They were the final surge before the cutoff. And Chinese domestic inventories, already strained from supporting both massive industrial demand and record exports, hit multi-year lows on the Shanghai Futures Exchange. This is where the industrial demand story becomes critical, because China isn't restricting silver exports to manipulate prices. They're doing it because they literally cannot afford to keep exporting when their domestic industrial consumption is exploding. Solar panel manufacturing alone tells the story. Each panel requires approximately 0.64 ounces of silver for the conductive paste that allows electricity to flow. China manufactured over 80% of global solar panels in 2025, and solar installations in China doubled year over year. That's not gradual growth, that's exponential demand. The math is terrifying if you're trying to supply this market. Chinese solar manufacturing is projected to require 783 million ounces of silver over the next 3 years. To put that in perspective, global mine production in 2024 was approximately 820 million ounces total. China's solar industry alone will consume nearly the equivalent of global mining output across multiple years. But solar is just the beginning. Electric vehicle production in China increased 40% year over year in 2025. Each EV uses roughly twice the silver of a traditional internal combustion vehicle. 5G infrastructure build-out continues accelerating across Chinese cities. Every tower needs silver components for signal processing and electrical contacts. Then there's the AI data center boom. These facilities require massive electrical infrastructure, all dependent on silver's unmatched conductivity. As artificial intelligence compute demand grows, the silver content per data center is rising exponentially. So, when China announced export restrictions, they weren't making a trade policy decision. They were making a resource security decision. The domestic industrial demand growth trajectory meant that continuing historical export levels would create shortages for Chinese manufacturers. And in a world where technological dominance determines geopolitical power, you don't let critical materials leave your borders if you need them at home. This is the fracture line. For decades, global silver markets operated on the assumption that Chinese supply would always be available. Mine output might fluctuate, recycling might vary, but China's refining capacity and export willingness provided the buffer that kept markets functioning. That buffer just disappeared permanently. Here's what happens when the world's dominant supplier stops playing by the old rules. Every other source of supply becomes exponentially more valuable. Mexican mines, Peruvian operations, Canadian primary silver producers. These sources, which were always important, now become absolutely critical. But here's the problem. Non-Chinese silver supply is constrained. Mexico's production has declined 7% since 2016. The easy, high-grade deposits are exhausted. Peru faces constant disruptions from community disputes. Primary silver mines worldwide are declining. The vast majority of global silver, roughly 72%, comes as byproduct of copper, zinc, and lead mining. When base metal prices are weak, silver output falls with them. This byproduct dependence creates inelastic supply. When copper prices are weak, copper mines slow production. Silver output falls with them. Not because silver demand dropped or silver prices crashed, but because base metal economics don't justify continued operation. So the available supply to replace Chinese exports is limited, expensive to ramp up, and dependent on the economics of entirely different metals. Meanwhile, global industrial demand continues setting records. This is not a temporary imbalance. This is structural scarcity. The markets are already pricing in the implications. Silver prices surged from approximately $30 per ounce in early 2025 to $78 by December 2025. That's a 160% gain in 1 year. But even more telling are the signals coming from the physical market. Lease rates in London have spiked to 8 to 9%. For context, normal silver lease rates hover around 1 to 2%. When lease rates hit 8 to 9%, it means there's desperate demand for physical metal from entities willing to pay almost 10% annually just to borrow silver for short-term use. That level of financial stress indicates the physical market is already breaking down. Industrial users, refiners, and traders are bidding aggressively for any available silver because supply chains are tightening faster than anyone anticipated. And here's the acceleration pattern. The export restrictions don't just reduce Chinese supply immediately, they eliminate the expectation of Chinese supply in the future. Every industrial user, every manufacturer, every electronics company that depends on silver now has to secure alternative sources. But there isn't enough alternative supply to go around, not at any price. Because while China was restricting exports, the rest of the world was scaling up industrial applications that require silver. Solar installations globally, not just in China. Electric vehicle production in Europe, North America, and other Asian countries. 5G networks, AI infrastructure, medical devices, electrical components. The demand is everywhere. The supply is concentrated in one country that just said they're keeping it for themselves. This creates a global scramble. Countries dependent on Chinese silver exports are already announcing supply diversification initiatives. The United States, which classified silver as a critical mineral in early November, is promoting domestic mining and stockpiling. European nations are negotiating supply agreements directly with Mexican and Peruvian producers. But these alternative arrangements take years to develop. Mining projects operate on 5 to 10-year timelines from discovery to production. Refining capacity requires billions in capital investment and environmental permits. You can't just flip a switch and replace 60 to 70% of global supply. The timeline mismatch is what makes this dangerous. Industrial demand is growing now. Chinese supply is restricted now. Alternative sources might be available in 3 to 5 years. If massive investments succeed and if base metal prices prices justify continued byproduct silver production. That gap between when supply disappears and when alternatives come online is where prices go vertical. Look at what happened with other critical materials when China tightened export controls. Rare earth elements in 2010, tungsten in recent years, antimony, which China also restricted alongside silver. Prices didn't gradually adjust. They spiked violently as industrial users realized their supply chains were entirely dependent on one country that could turn off the tap at any time. Silver is following the same playbook, but with higher stakes. Because silver isn't just used in advanced technologies, it's used in basic electrical infrastructure. Every electrical contact, every circuit board, every solar panel, every battery system. You can't run a modern industrial economy without silver. And now the world's primary source of refined silver is no longer available on historical terms. The implications cascade through every sector. Solar manufacturers face higher input costs at exactly the moment when renewable energy installations are supposed to accelerate. Electric vehicle producers see margin pressure as a key component becomes scarce and expensive. Electronics companies must either absorb higher costs or pass them through to consumers. But the real impact comes when substitution proves impossible. Silver has the highest electrical conductivity of all elements, the highest thermal conductivity, unique antibacterial properties. In most applications, there is no substitute that maintains performance levels. You can use copper instead of silver in some electrical applications, but efficiency drops. You can redesign circuits to use less silver, but reliability suffers. You can optimize recycling to recover more silver from electronic waste, but current recycling rates are only around 18%, and improving them requires massive infrastructure investment. For critical applications, aerospace, medical devices, military electronics, renewable energy systems, there is no acceptable substitute. These industries will pay whatever price is necessary to secure silver supply. And when industrial users with inelastic demand compete for limited supply, prices rise until demand is destroyed or new supply emerges. Since new supply takes years to develop, and China just eliminated 60 to 70% of readily available refined silver, the adjustment mechanism becomes price. Extreme price increases that force marginal users to find alternatives while preserving supply for applications where silver is absolutely essential. This is why Elon Musk's response to China's export restrictions was immediate and blunt. This is not good. Silver is needed in many industrial processes. He understands the supply chains. He knows Tesla's dependence on silver for electrical systems, battery components, and charging infrastructure. And he recognizes that China's move creates permanent scarcity for a material with no adequate substitute. The market structure that emerges from this shift looks fundamentally different from what existed before. Instead of abundant, cheap silver traded as a financial instrument, we get scarce, expensive silver allocated based on industrial necessity and geopolitical relationships. Countries with domestic silver resources become exponentially more valuable strategic partners. Mexico, Peru, Canada, Australia, nations that never thought silver mining was particularly important, suddenly find themselves holding critical industrial inputs that everyone needs. Recycling becomes a strategic industry instead of an afterthought. Electronics manufacturers that can recover and reuse silver from production waste gain competitive advantages over companies dependent on virgin supply. And the financial markets trading silver futures discover that their contracts are worth exactly what they can deliver physically. Because when supply is genuinely scarce, paper promises become worthless if they can't be converted to actual metal. This is what permanent supply disruption looks like, not a temporary shortage that gets resolved when prices rise. A structural break where the world's primary supplier decides their domestic needs take priority over global markets. The timeline for resolution isn't months or quarters, it's years, potentially decades, depending on whether alternative sources can scale up and whether substitution technologies can be developed and deployed at industrial scale. China's silver export restrictions represent more than trade policy. They represent the end of the post-Cold War assumption that critical materials would always be available through global markets, regardless of geopolitical tensions. We're entering an era where resource control equals industrial power, and nations with domestic supplies of critical materials hold leverage over those dependent on imports. This is not speculation. This is industrial reality. And silver, the metal that makes modern electronics possible, just became became the first major test case of how this new world order functions. The direction is set. The only questions are how quickly the shortage becomes undeniable, and how high prices need to rise before enough demand is destroyed or enough new supply emerges to restore balance. But restoration of the old balance may be impossible if China's domestic demand continues growing and they continue prioritizing domestic use over exports. Now, let me show you exactly who wins and who loses in this new reality. The winners are obvious. Countries with domestic silver resources just became geopolitical power players overnight. Mexico's 186 million ounces annually, Peru's 111 million ounces, Canadian and Australian producers all suddenly control supplies everyone desperately needs. Primary silver miners become exponentially more valuable. First Majestic Silver, Hecla Mining, Pan American Silver, these companies control dedicated silver supply in a world where such supply just became irreplaceably scarce. Industrial users with secured supply contracts win. Companies that negotiated long-term delivery agreements can continue production while competitors scramble for spot market metal at dramatically higher prices. The entities that lose face existential challenges. Manufacturers without secured silver supply. Electronics companies dependent on just-in-time inventory. Solar panel producers who assume cheap Chinese silver would always be available. Here's the cascade effect. When silver prices spike from $30 to $78 and keep climbing, costs get passed through the entire economy. Solar panels become more expensive. Electronics cost more. Vehicles increase in price. This is resource scarcity inflation that can't be solved by interest rate policy. The timeline suggests we're still early. China's restrictions took effect January 1st, but existing inventory provides a buffer. Based on consumption patterns, that buffer lasts 6 to 12 months. By late 2026, the physical shortage becomes undeniable. That's when paper markets face their ultimate test. COMEX futures, London trading, silver ETFs all depend on physical delivery assumptions. When silver becomes genuinely scarce, those assumptions break down. We've seen this before. In 2020, physical silver coins sold for $12 to $15 over spot because dealers couldn't source metal. Imagine that dynamic, but permanent and much larger scale. Paper silver at $78, physical silver unavailable at any price. But here's what makes this different from previous squeezes. The Hunt brothers in 1980 were leveraged speculators. Exchanges could change rules, force liquidation. You can't margin call a country. China's decision reflects permanent strategic calculation. This is the template for resource nationalism. Countries discover more power from controlling critical supplies than selling them. We're likely to see similar policies for lithium, rare earths, cobalt. The assumption that critical materials will always be available through global markets just died. This isn't about predicting the future. This is about recognizing a pattern playing out right now. When the world's dominant supplier of a critical industrial input decides they need that input more than the export revenue, everything changes. And in silver markets, everything just changed permanently.